Great. Hi, everyone. Thanks for tuning in our Oaktree or Rise on McDowell investor webinar. This is our first ever. We don't have promises to do it again, or if this is something that does well, maybe we'll do it kind of more often. So just a few housekeeping things. Kavita over here is going to help me monitoring the Q&A questions. This is a highly interactive session. You know, we thought it would be a great time for us to kind of walk through the April updates that we have for you, actually March updates and the April updates that we have for you this far. Really, we feel like it's really good to have an open channel to communicate between the investor and us, and giving you guys some more insight into where we at with Oaktree, with all the late COVID-19 crisis. So the session will be recorded. Just a few housekeeping things. Please put your questions in the Q&A, and so we're gonna answer them. There's parts of the session we're gonna stop answering them as we go. So hopefully that is gonna help answer some of your questions, because that's really the premises of us hosting this. So I want to just give everybody a quick shout out over here on my host. So I've got my partner Zach over here join us.
Hey everybody, thanks for joining today. We're excited to give you guys an update on what's going on with the Rise on McDowell.
Awesome. And then I have Robert over here as well. Robert's a little, he hasn't trimmed for a little bit. Like all of us, we stay at home, quarantined on this. Hi, Robert.
Hi, everybody. Thank you for joining. If everybody's really staying home, you got to the point where you got pretty bored in life. So we're happy to interact with some of you, and we're looking forward to maybe having more of those.
Yeah. And then we have a Kavita who's joined us from Texas. She's going to be the Q&A girl.
I am muted. Hey guys, sorry I was muted. Good to have you guys on, and I'm happy that we're doing this, because I think as investors, you might be thinking about what's going on with the investments, with all the news floating around. So hopefully your worries will be, laid at rest after this and answered. Thank you guys for joining.
And then we have the Kitty sisters over here with us too.
Guys, thank you so much for joining us. I think I can echo what our other co-sponsors are saying, that it's really important right now to kind of keep the communication going and just to put your mind at ease at what's happening at the Oaktree deal.
Cool. And we have our star guests today with Randy, who you can't see because Randy joined us on the phone. He is our regional at Oaktree from Shelter Management. And Julie, who is our star guest. She is the on-site, really the eyes and the boots on the ground, dealing with all these things daily. So thank you to Julie for joining us, and thank you for all the hard work on this property. Cool. So I want to kind of I didn't really prepare slides or anything for this, but I thought a very well kind of organized a lot of information, already packed them on the investor updates. So this is a report that you will be receiving as part of the March update. We have them ready. We received the financials yesterday, and I typed this up. So we want to kind of go into the presentation we'll be having. We're going to talk about COVID-19, obviously what's hot on our mind, another reason why we're here. And then there's sections that's just on March updates. And I think right now a lot of stuff is being reset. So we want to kind of mostly spend the time talking about COVID-19 stuff. So just a few reminder and announcement over here. I want to just making sure everybody got their K1s. Yay. Raise your hand. If you don't know how to raise your hand, you can do it on the video. Want to make sure everybody got the K1s. The K1s was out of March 16th. If you haven't got them, email me, email all the co-sponsors over here to get your K1s. And then if you have any amendment, we have filed the tax, so that would potentially cause an amendment, but send them to us if you have any amendment with addresses, names, and etc. We want to make sure that these are correct. Okay, so, and also just kind of setting the expectation is, you know, I was kind of deciding between, we were kind of deciding between whether doing a weekly update on collection or 2 weeks. I think we're going to start with every 2 weeks, we're going to give a collection update. Because what's happening is we're sitting on a weekly call with our PM, but what we noticed is like really up until the 10th of a month, there's not much to update, just because the nature of tenants and et cetera, you just don't know, right? So it's kind of like worrying for nothing sake. So really, I think a 2-week cadence is really good in terms of how we're doing collections and et cetera. So we're gonna start doing 1 paragraph snippets on how we're doing, you know, nothing super fancy over there, to start sending it to you guys. So the next one that you should be expected is maybe the end of April. You should get a snippet on the, hey, how we're doing, until we close the book. And then, you know, May 10th-ish, you will get a paragraph on that too. Okay, and then if we feel like there's need to more frequent communication, we'll do so. Okay, so just want to kind of set these expectations over here. So COVID-19, we kind of want to talk about like, hey, so what does all this stuff affect us? So as you probably read on the news, and this is something that Zach has digged into quite a bit, you know, the Freddie loans, basically Freddie is what we used as a lender, is backed by Fed. So as some of you guys already, and some of you don't know, is any loans that is backed by Fed is now putting a restriction on eviction all up for 120 days, which means that just means that we have a little bit less lever to our tenants. So conversation with them has to be a little softer in terms of collection, etc. And Julie will show you how she does these collections on these daily basis. But because we don't have the eviction on our hands to potentially, you know, use as our lever. So that's something to kind of keep in mind. But Julie is going to share like how they actually approaching this and try to mitigate the fact that we don't have evictions anymore, right? So I want to just kind of share a quick summary on April doing so far. So in April, a high level, we don't see a lot of impact over here. We see a few units over here that they have given us notice they got impacted. I think a total of 3 units, right, Julie? But overall, not huge impact, that we were able to kind of give them the resources to help pay for the rent. Our prediction is so that May and June may get worse. So far, however, lease up has been impacted dramatically. And as you know, we're in the middle of the lease up. So this is potentially slowing down the velocity of us doing the value add and renting up the units. So we only got 1 updated 1-bedroom that was a performer that got rented during April. We had a prospect on the 2 bedrooms, but I think they decided to kind of preserve their funds and decided to back off it. And so we had 2 scheduled to move out by the end of April. We're also actively looking at the renewals and then try to do everything we can to keep the people in there. There's multiple different strategies that we've made in terms of trying to get people to renew more. So that's very much a focus there. And the total vacancy is about 9 currently. And that's not including the pre-lease or move out. So at the end of April, when these 2 people move out, if we don't rent up any units, we're gonna have 11, right? So at the bottom of the barrels there, we had experienced 13 back in February. So we could be looking at 11 at April. We made some headwinds in March. Okay, so rent owed to us. This is something that maybe, you know, with this specifically you'd be concerned about. We're actually doing pretty good compared to all the other months that we have. We only have about $3,000 that is owed to us, not including the Section 8. So in Phoenix, Robert can chime in on this, you know, like getting a check from Section 8 is very difficult, but the good side is the Section 8 do pay, but oftentimes we're getting a backup check over there. So that's where you see the total owed to us is about $8,000, but only $3,000 is on the books, at least when we looked at it. Was basically not Section 8 related.
Yeah, and that's a good point, Elisa. Just real quick, I'll chime in there. So like you said, I mean, we fully expect to receive those Section 8 rents. We don't ever have an issue with that. And so like on a percentage basis, we have 95% of collections have come in for the month of April, which is very strong for being about middle of the month. So, and that's not including the Section 8. So we're at 95% collections for non-Section 8 collections for this month. We feel pretty good about that. I think we had an expectation that it wouldn't be as strong in April, but it has been, fortunately. And so we'll see how it goes in May. We would not be surprised if May is tougher just because the quarantine has gone on for longer. But that just kind of gives you guys an idea that right now we're about 95%, not including Section 8.
Yeah. And then the reserve balance. So this is an item I really want to highlight. If you take away anything, like, you may have other investments, etc. But our reserve is super strong. We have about more than $1 million reserve, which actually, unfortunately, doesn't show up on the balance sheet. We've been working with our PM company to put this in the books. No, that's not Julie. You don't have to look at her about that. Someone else who's doing this. But we have $1 million in reserve, which I'm going to jump into later in the stress test. What does that mean to us, right? So a lot of other property, unfortunately, our colleagues is not in a position with such a reserve over here. So reserve is a key over here to kind of help us ride out the lows. So what we have been doing is we have been kind of creatively structuring the incentives to renew the renters. I think the focus is on renewal. So you will be seeing us throwing some more concessions and etc. to kind of bring the renters up to renewal. Now, keep in mind, our property is about $200 in the market, like $100 to $200 in the market just on the current rents. So we have kind of stopped doing renovation right now, because if we have 9 units vacant sitting there, we're only updating half of them. We actually stopped the renovating starting March even, because when we have many units that is sitting vacant, we want to make sure the upgraded unit gets moved, but not at a discounted price. Right, so we start doing classics, because classics, when people purchase the property, they kind of view them as a value add opportunity. So we want to keep it that way, but show the updated units as in like, hey, we can hit these performance. So good news in March is we actually leased up a 6 unit. A majority of them are large 1-bed at our performa. So that sets like the benchmark, which is great. So it allows us to kind of be a little softened on the rent this month if we have to. Again, this is something changes hour by hour. We literally just discussed it this morning. We have more meetings tomorrow to kind of discuss if these are exactly the price we want to be. But to kind of just a summary is we may be dropping our classic unit that we just do in a turn to like $850, which is still, I want to emphasize over here, which is still $100 to $150 than our current rent on these units. Which is great, because this is, again, buy it right. This is an asset that was super under rented. So it was allow us to potentially play with these numbers. And also we're going to drop the updated 1 unit to 900. That one, we're going to be a little hardcore on this. Julie's going to, obviously fill it out before. But the thing is, if a tenant is showing up, first of all, the traffic has dropped dramatically during this time, because simply people don't want to move. Or even get out of the door, right? So if they are here, then the conversion rate typically is a little higher. So if they're not converting, that means there's competitive product that's out there that's also dropping their price. So we want to make sure that we play with the market instead of sitting there, setting up a number and not have the units filled up. So once we fill up 5 units out of these 9, we're sitting at about 4 to 5 unit vacant. That's where we potentially going to get a little less aggressive with these, rent adjustments. Cool. So these will have some impact on the exit, obviously, but based on our conservative reversion, because it's based on NOI, right? So, but based on our conservative reversion, this should probably be okay, because that will be able to kind of absorb it. So, and another reason why we conservatively underwrote everything. So Julie, I want to kind of cut over to you for a second over there. Can you kind of give us just a little color on what we've been doing at the property for combating coronavirus here?
Sorry, it wouldn't let me unmute there for a second. So we have, in addition to our weekly meetings that we have every Friday morning, we talk. However, we do have other moments where we'll notice kind of a change or a hiccup or a bump, and I'll call Lisa, or I'll call Robert, or I'll call Zach. We'll have those moments. We have adapted some of our marketing. Marketing is primarily done online. We have a listing program that lists to multiple sites, but primarily Craigslist. We have apartments.com, and we have our website. I'm noticing lately that our website is getting more traffic, more and more and more. We've also, as a company, in response to the COVID-19, because we've had to stop doing physical in-person tours, and we've had to adapt to something that's kind of an alternate reality, we've got a product called LeaseHawk that is part of our phone system. That product has an AI answering service. So it allows us to have a 24/7 leasing agent that is artificial intelligence available to us to set appointments, answer questions, lease apartments, do a lot of really cool stuff. It's been a really neat thing. It's only really been active for 3 or 4 days, and we have an appointment for tomorrow. We additionally have been working with our residents a lot. We've always had a program where we've got a resident referral. Again, we're going to market that again, because if they have friends who are still working, we want them to live here. We have, through the Arizona Multi-Housing Association, developed a program for collecting our rents, which has helped us this month. And basically what that is an approach where we can reach out to people and talk to them, and it's a check-in, and it's, can we offer you these services? So since beginning this, our experience has been that several residents have come back to us saying, hey, thanks for the referral. And we've reached out, we're getting help. It's so easy. Now, yes, it's easy to get approved. Unfortunately, these companies are so overwhelmed. It's just taking a little bit longer to get that money. I have a particular resident at Rise who was really on top of it, I'm seeing this come down the pipeline. And she was the first one to use this right at the beginning, like right that first weekend that it really hit all of us, which was right around St. Patrick's Day. So she jumped on that very, very quickly, and we are confirmed to be getting the money, but we have not received it yet from them. So it just tells you kind of the wait time of what we're looking at. Because we can't evict, it doesn't mean they don't owe, and it doesn't mean that we're not going to continue to aggressively pursue the rent. All it means is we can't change the locks at the end of the month like we normally would. It also means we have to up our game, because there are people who are willfully going to withhold because they aren't reading the fine print. And there's a lot of different things going on with that. So we are, we're trying to keep social distancing and keep away, but we are also trying to effectively communicate with people via email. One of the residents I was on the phone with and emailing all the information to get assistance because he wasn't going to be able to pay his rent right away. So it's really, we've had to really step up our game, make sure we've got the good phone numbers, really work at being present in the office every day, responsive. So it's fun. It's actually been a little fun.
And Julie, it's kind of interesting to share. A majority of our audience over at the Rise is Hispanic, and they don't use internet before this crisis. Have you seen kind of like a change in terms of how they're using technology to kind of help, kind of in a more positive way? Because we've been trying to get them on the internet forever.
A few have shared an email address that they've created at this point, but most are still on the phone over there.
Gotcha. Now, can you walk us over on like some of the things that we did on site to kind of keep our residents somewhat safe, or at least the perception of like making sure that they are safe?
Sure. Right as this went down, we went ahead and ordered sanitizers and wipes and gloves and various other things. At the Rise, we do have a communal laundry room. So we are daily mopping with bleach. We're doing, railings on kind of a everyday basis. We're doing a few railings, trying to just really keep our part going. Power washing sidewalks. There's a lot of work. So one of the things we did this week was we felt like after a month, and even though we've been cleaning it, we had our housekeepers who normally clean our apartments for us come in and be very visible, disinfecting all of the machines, all the sinks, all the countertops, all the handles, deep scrubbing the floors, and really, really trying to be super visible with the items that are so important to keep clean right now.
Gotcha. Yeah. So I mean, during this time, it's kind of really important to make sure that our tenant feels safe. That's that kind of leads to potentially renewal and customer service, right? I think we have a question over here. Kavitha, you want to shout it out?
Yeah, what is the possibility, Tushar asked, what is the possibility to defer rent without evictions with nominal interest? For example, you see Chase Bank Mortgage, they allow 3-month deferrals, but with heavy interest.
So that's a really interesting question. I think we're taking an investor spin on like what a tenant situation possibly is. This is in our rental world. It's going to be usually it's the late fees, but I think by restriction, actually, Randy, remind me, can we charge late fee when we're on the Fed program? No, right?
We can't. No, we can't. Not under the CARES program. We can't charge late fees for 4 months.
Okay.
Yeah. So our late fees are kind of a nil point at this point, right? So we can't actually charge them like a late fee. Was I think the interest that you mentioned over here kind of translate into a late fee. In which case we currently, because it's a Freddie loan, we're actually restricted to that. And then if in this situation, we actually just care about them paying versus like nickel and diming them, because if we look at it, we're having like 9 vacancies sitting there, right? So taking that one unit, for example, it's $1,000 a door. So if we're gonna drop $50 or $100 to keep that tenant there and not have vacancy because lease up is a challenge right now, we'll do that. And then, based on some of the research, and I've been kind of doing a lot of webinar listening lately, the sentiments that are on the experienced operator just seems to be they're ahead of the curve in terms of providing discounts and etc., because they recognize the need to keep the tenants in there is more important than anything. Yeah, great. Cool. All right, so and thank you, Julie, because I think, we also, just to kind of mention, we also have an on-site on the Rise on McDowell. And then she is a full Spanish speaking person. So that really helps with our current tenant, profile. And then in case if they got engaged with unemployment, we were thinking we can kind of help them through the process, etc., because these processes are sometimes hefty. But in some cases, they were assigned case workers. That's what we came up and found out. So if someone was motivated, they apply for it. It seems like the path to get that money is pretty easy. but the speed of it, like Julie has mentioned before, we could take a couple months, 1 or 2 months, like the Section 8 tenant checks. So again, this kind of goes back to, we now have to kind of take it at a quarter to quarter basis when we're evening out all the numbers to normalize it. So something to kind of keep in mind as well. Cool. Well, thank you so much, Julie. Randy, do you want to kind of have anything to add? Because Randy actually oversees a majority, like a whole bunch of other properties, because he's our regional over here. How would you comment on Oaktree is doing compared to, you know, your whole other portfolio of what Shelton has owned, working with different owners?
Yeah, I think the collections have gone very well. Of course, being a CARES property, well, it puts us under, you know, tighter scrutiny, of course, in the things that we can or can't do. I have some clients that, you know, they don't have federally insured loans, so they're kind of proceeding, you know, business as usual in terms of evictions and that sort of thing. But, you know, just kind of looking at collections, the property is doing the average of what we're seeing in the Phoenix market, and possibly slightly ahead of other CARES projects. But, you know, I think it's good. Well, April would appear to be on a positive trend. Of course, you know, May could get a little bit more scary. You know, we don't know. Now the stimulus checks have started coming in. People are getting paid, and we're hoping to see that money, you know, come towards rent. Those that have lost their jobs, if they're collecting unemployment, they should be getting unemployment checks. So I think for us, you know, we can probably head off May a little bit. You know, Julie's doing a good job communicating with people on a daily basis, which is pretty critical. And, you know, pretty much every manager's job right now behind locked office doors, it's just a ton of communication on the phone, emails, you know, trying to work with people as much as we can. You know, we don't want to throw anybody out, obviously, if they have the ability to pay. So we want to work with them as much as possible. But ideally, we don't want to carry, you know, somebody for 3-4 months, which, of course, the executive order mandates that we might have to. So, you know, I think it's kind of, you know, 1 week at a time in terms of collections. But I want to say where we stand right now, we're in pretty good shape.
Thank you so much, Randy. And Randy has been
Sure.
kind of like a key person here, because he has insight into other property that they're managing at Shelton, various, as you mentioned before, the, you know, like CARES related or not CARES related. This is the Fed backed properties or not. So he was able to kind of bring some insight every week creatively on how we can potentially tackle problems there. Great. All right, so I'm going to proceed over here, kind of go through the rest of the packages over here. So I think, you know, people obviously will talk about, hey, what's the impact on exit? Like, what is this reset to, right? So I want to kind of talk about that later a little bit. And then the first I want to kind of also share, you know, like the stress test that we have done. So given that we have such a big reserve or CapEx budget, and initially we were thinking about updating, you know, only 20% of the unit. In fact, I think we potentially raised way more than we needed to. So, you know, like, I think we're in a very good, safe spot. So what I did with the stress test is I just assumed that full expense is about $28K a month. This is taking the average of past month. Now, keep in mind, remember when we took over this property in August until December, we were full, 100% full. So when you have a 100% full property, your expense is a lot higher, right? So keeping that in mind, that's taking an average of the other month. I want to always take a more conservative approach. So it's 28K that we assumed. And then on a base collection, which means where we at in April, what is our base? So giving all the people who are paying, what is our gross rent over there, versus using a projected collection, which is, hey, we're assuming everything kind of goes heavy and dandy. What is our projected rent, which will be a lot higher. So a lot of time people, when they do stress tests, you should be using your base collection to be on the conservative side. And all the vacancy mentioned below is economic vacancy. I can have a person in there, if he's not paying, I'm counting that as a vacancy. So the scenario after we run the test, so here is a house safe like this property seems to be, is it will last us 2 years, 2 full years with 100% vacancy with full expenses not being paid. So that's if nobody's paying us and we're literally just, you know, not moving them out, and then we're paying the full expenses, right? So that's 2 years. And I think that is giving you a lot of reassurance on where we're gonna fare over here, right? And then more realistically, if it's a 50% vacancy, which could get to for a couple months, right? I'm not kind of sugarcoating it because we never know what macroeconomic is going to do. But 50% vacancy based on the current base rent, which by the way, we're collecting 95 right now today. So if that dropped to 50%, which we don't think we're going to get to, that's going to last us about 7 years with collection at full expenses. So that's going to ride out the word low. This is really reassuring. And we'll break even if we use a projected collection. Let's say Julie worked really hard, leased a couple units, we can start looking at the projected collection. So if lease up goes better, then at the full expenses will be about break even at a 50% vacancy, which is great because we're not even needing to tap into that reserve. So I want to kind of share these. You know, folks can have comments, other question how we calculate it. Put that in the Q&A if you want to. A really silent bunch over here. Okay, so the next session over here is probably where you guys really have questions. So what does that mean to my investment, right? So I think when crisis like this happens, we like to kind of model like what actually going to happen, and kind of see a trend line of like, hey, how are we going to write this out, right? So I kind of did a quick, dirty modeling on this. We don't obviously have crystal ball, but it's good to be prudent to see like, hey, what's the worst case scenarios over here. I don't really know what the worst case scenario here is, right? Some people have said the lockdown is going to happen until 2021. That would be like really bad. I don't think that's really going to be that long. But you know, the virus may return. So we don't know. So all I know is if we do projection overall, like, and the method I did use over here is I looked at each unit, how each lease up is going to impact our total return in terms of investor returns, investor cash on cash returns, because nobody cares other returns, right? It's investors cash on cash return. So this is kind of where we're trending. You know, because we had a full occupancy over here, we were a little low due to some higher expenses over here. So here's a little behind. Then on December, we kind of caught up. And then we were predicting, because January is when we can start turning the tenants out, we were predicting the January number drops down and February will also be low, even lower. And then March, we start seeing a back. So overall, this is our actual trend and this is our kind of projection month to month. They're kind of on pace, as you can see, maybe a little better. Our March was actually phenomenal. We leased up 6 units after we fixed some advertising issue in February. March picked up really a lot. So that was actually really great to see. You know, we have to tighten up the expenses and et cetera a little bit, but we have to spend some money on advertisement and et cetera. So, but overall, it's kind of pretty much on trend for our first year. This is just first year. But with the Corona hit over here, and I've been kind of looking at how much we would drop and also look at our exposure rate. Like assuming our tenant's gonna leave and we're able to kind of lease up 1 or 2 units a month, this is kind of where we be trending. So overall, because we're at the tail end of the first year, we may be performing, so far we're kind of as par, you know, with our projection, but we were counting on like, hey, because really starting March is like the heavy like lease up season for Phoenix. So this could potentially be even higher, but because the Corona stuff happened, we have an issue with lease up. So that's where I would say, you know, conservatively, we should take a projection of a 4.7, which is our first year projected, and then tag on a 1.5% deficit over here because, you know, the virus has hit us in terms of the lease up. So I would expect we'll probably end up the year to be about 3.2, 3.5 versus 4.7. We may fare a little bit better. Kind of don't really know, but I want to kind of just be transparent and show you guys where my crystal ball is telling me.
Yeah, and to give you guys an idea, as far as Arizona, like a national context, Arizona, relatively speaking, has not been hit very hard by COVID. Governor Doug Ducey has started talk this week about possibly opening things up the next couple of weeks, opening up the economy. So we'll see how that goes, obviously. And so, I mean, obviously, we don't know what the future holds. We don't have any indicators that there's going to be like a full lockdown if this would continue much longer. I think President Trump had an announcement about 40 minutes ago began. He was going to give new guidelines. I don't know what those are yet at the time of this recording. But, I mean, I think as far as compared to other states, Arizona has not been hit very hard. The curve is flattening as far as we know. And so hopefully this will start to open up. And again, I think Elisa here did a good job being conservative and projecting a very worst case scenario. And so we may or may not realize these results. So it'll just really just depends on how things go here in May and going forward.
Yeah, and then we know that, you know, because we have that healthy reserve, we're going to distribute a dime collected. We're going to distribute that to you, right? Because there's no need for us to hold the money. Unlike some other projects, you know, if we're at the second year or third year, you use that for all your CapEx, the reserves, and et cetera, you may want to hold that. It's actually a prudent experience thing, like an operator thing to do, to make sure that you hold that to ride out the low, instead of distribute that to you and then ask for a cash call, right? So that's why if you have other projects and et cetera, they're not distributing, they're holding off distribution, that's probably what they're doing. Because we're exceptional over here because we have so much reserve, we don't see the need to hold on to it. So we will distribute to you because we recognize, yeah, it's not a lot, but like right now, everybody wants to grab cash. So there's no need for us to hold it up for you. And kind of just segue to, you know, our projected, like based on normal distribution schedule, your next check should be coming in May. That's encompasses of February to April. So right now, it's actually perfect that we're going to do an assessment in May to see if we have a whole bunch of negative accounts coming up in May, because we don't know what May and June is installed. Then we're going to have to readjust it a little bit. But if all things kind of goes to this model over here, we should have something to distribute. Maybe not a lot, but we will be able to kind of distribute whatever cash that we collect over there.
Yeah, no, and thanks, Lisa. That's a good point. Just to kind of recap what Lisa was saying, just to be clear with everybody, all the investors. So prior to COVID, our next scheduled distribution in a normal environment was scheduled to be at the end of May. Okay, and so we're going to see how collections go for May, and if they are strong, then we'll plan to continue and make that distribution. If there's a big deficit, like Lisa was saying, then we may reduce or postpone that distribution. So fortunately, April was strong, and so we'll see how that goes going in here to May.
Yeah.
The next.
And March was pretty strong as well, to cap that. And then the other thing is, I think this kind of paint a more grim outlook over here. But after that, I also modeled the second year. So the pace actually moves up starting in July, but on a slower pace is kind of what I had over here. Unfortunately, I can't show you over here. Is kind of missing off. And this line kind of tapers off at some point. So essentially what this net takeaway is, you know, things going up to where we expect it to stabilize, it's going to get delayed about 3 to 6 months, is conservatively what I'm projecting over here. So you can kind of see a little uptrend over here, but I didn't include that in the graph over here. Okay, so segue to like, what does it mean for long term then? So there's actually another thing that is impacting us. I want to just kind of explain a little bit too. Is at the time when we purchased the property, the interest rate was going up. So we took the opportunity to take a yield maintenance. because based on calculation, when we're looking at, you know, X amount of day in the future, we'll take a lower rate, thinking the rate's going to go up. But unfortunately, right now, the rates are getting slashed. Right now, the rates are still more than what they were before. But over the next period of the 6 weeks or so, I think the rate's going to settle down. It's going to be lower. So what that means, when you have a yield maintenance loan, it means potentially equates to a higher prepayment penalty. Can we make this up? Yeah, it's no issue. If we have a valuation goes up, you know, we'll do that prepayment penalty. It's something that we kind of play with, but it's conservatively, we can kind of take this situation. If Trump gets reelected, likely the rates will still be low. If someone else took the office, which you really don't know at this point now, then that could go the other way, right? So it's kind of like tossing the coin over here. But we want to kind of just bring to your attention. Our original plan was like, hey, we get this thing up, we get it stabilized, then we put it on the market. To be honest, the velocity that Julie and the team has been doing was phenomenal. As you can see, that big trajectory in March, we could actually potentially put this property on market, you know, in a year time. But unfortunately, given this situation that happened, we got to be more prudent with this. So instead of putting it on the market for, you know, 2 years time, get it sold less than 2 years, we may be looking at maybe holding on to this for 3 to 5 years, right? So it really kind of depends on the interest rate, the market sentiments, and etc. But we're going to be hitting our numbers. But I want to kind of show this up in terms of time-wise. This may take longer. You know, I want to make sure that we understood that. And also the number of the units while we holding it, because it was supposed to be a quick term. So we don't really care about the cash flow too much. But if we have to hold it a little longer, then we have to look at the cash flow game. So that's things that we will adjust within the team. So initially, when we're thinking about only 20% of units updated is good enough, just to kind of show the proof of concept, right? And then capitalize on the low cap rate. But now in reality, when we do this, we may have to update up to 50% of the units and get them rented at a premium, and then potentially cash flow bigger. So you're going to get bigger cash flow, but we potentially have to hold it longer. So that's kind of how we're looking at situation day by day and try to adjust our exit plans. Okay. In our regular report, I'm just going to leave it over here. This report will be sent out. We'll include this snippet of the video over here, so you can kind of revisit it if you want to. But our regular report just kind of talks about the March. That's usually what we do. We got our financial package from our PNs around the 15th, and then we decorate the report this way. So we'll have a summary of what we have kind of got from March, essentially. And then we had basically a trend up, as you saw about. So currently we're trending about that 3.2, which is what we think. But initially that May to July is where we kind of go in and kill and potentially see a 5% total there. That is likely not going to happen. So which is why it kind of derives to the 3.2. We may fare better. Depends on how we're collections and etc. That's pretty much I have to share. Do we have questions? Because again, one of the reasons why we do this webinar is making sure we have open communication and address any of your concern and questions. You know, we'll now open it up for our questions.
And until there's some questions, I just want to clarify too for investors who have questions, because I've received questions the last several weeks. So regarding the CARES Act, okay, so the CARES Act is something that took effect March 27th, and because this is a Freddie Mac loan, we fall under the CARES Act. And so what that means is that we cannot evict any tenants until July 27th. It also means we cannot charge any late fees until July 27th, and we cannot deny a current tenant the opportunity to renew a lease until July 27th. So when you heard Julie, Randy, and Elisa speaking about kind of our strategy here, we have to adapt that strategy around the CARES Act legislation. So that's just to give you guys an idea. So that's why our goal is to maintain high occupancy, maintain collections and liquidity in the asset. And like Elisa had mentioned, we feel like we're well positioned to do that because assuming we receive no collections for for 2 years, we can still pay our debt service and our expenses, our operating expenses. And so I know another big government program that's been announced in the last couple months is the defeasance, which is basically deferring your mortgage or deferring your debt service up to 90 days for Freddie Mac and Fannie Mae loans. We don't have any reason to do that because of liquidity that we have and the reserves that we have, and we don't want to do that. And so that's not the plan at this time. We don't plan to utilize that. Like we had mentioned, we can pay our debt service, we can pay collection or expenses rather for several months. So we don't see a need to do that at this point. But yeah, so I know you were talking to Lisa about exit plan and how we may have to adjust that. I think it's just too early at this point to kind of see. We'll have to just see how things trend throughout the rest of the year and adjust accordingly. So
yeah, I just want to share kind of like the more conservative worst case scenario. This is how we're going to adapt, because like any projects that we have, we always have to have multiple exit strategy. So in this case, we'll just like up the cash flow and potentially hold it longer, right? So overall, we'll return back the amount of returns that we have talked about before.
Hey, Lisa, I had an offline question from one of the investors about how we are using the SBA loans, whether it's EIDL or PPP. Are we leveraging those?
Sorry, repeat the questions again.
Oh, about how we're leveraging the SBA loans. Are we taking advantage of any EIDL or PPP loans? Or the property management company taking advantage of the PPP loans?
Yeah, I think we have discussed about that with Randy, right? Like the PPPs and et cetera. I think right now, based on all the stuff that we kind of look at it, it's like, okay, the PPPs are no-op. I've been to like so many webinars now, like unless if you have a payroll, you cannot take advantage of that. So we've been kind of working with our property management, talking with them about it. But there's also like a really trick because the PPP is really a loan. So the way that's structured, it will require our property management to take a liability in case we don't pay back the loan. So there's a lot of these complications involved. So we're not taking PPP loans right now.
Okay, because PPP is forgivable though for payroll. Isn't that forgivable? Yeah.
Yeah, possibly. But currently how they're structurally is that there's still a lien that would be taken on the property that's taking out of PPP. But we don't have payroll, like, so it has to be Shelton that takes that, right?
Right.
So the accounting and the liability is just something that potentially our PMs don't want to take on. It gets the books really convoluted. So we're not currently taking the PPP, but the IDO is an interest to look into. Actually, Robert, you may want to chime in here. Robert or Zach, like, have you already filed something on the IDO to potentially take that advantage? Because my understanding also falls back into individuals where that goes. Like for me, I haven't applied for this property specifically because I have other businesses that have applied for IDO. You know, some local stuff that have. Yeah.
On the PPP, even if Shelton wanted to, there is a restriction that it has to be up to. It can only apply if you're up to 500 employees. And Shelton merged, I think the beginning of this year with another company. So they exceeded the 500 minimum or a maximum of employees. So we kind of ran around this with Randy and we decided that we're just probably not going to take advantage of it. But on the EIDL, I did file on EIDL, and to my understanding, this is $10,000 that you receive, and it's a grant. It's not a loan, it's a grant. It's given to you. It's yours to keep. So I know we've done it on some other properties. I'm not sure if we did it on the Rice.
Yeah, and then I think for IDO too is like for some of my folks who start receiving this check now, because this week is start to go out. Looks like that the expectation has adjusted, so it's basically at $1,000 per employee. So if Robert applied for it, he'll get $1,000, but capped at $10,000. Let's say Robert has 10 properties, he applied for all 10 of them. Then he's capped at $1,000 and then $10,000 total. That's if he can get all that, right? So I would encourage all the listener over here to kind of take a look into it because it's capped at an individual. So we can all apply, but if your total taking is less than like, more than $10,000, you won't get any more than that. So it will be interesting for folks to kind of look into it. And Kavitha, I know you've done some webinars on this stuff too, on the application, and I can send a link out. I've done some webinar on this too, but I can send a link out for the IDO, like the Express. Thank you to one of my investor who's on the call over here. He sent me this link. So there's an Express link that you can try to go out and try to apply. I mean, it doesn't hurt to try to apply based on this property. But it's not sure if we're gonna get them or not. But it's something to kind of look into. Thanks for bringing that up, Kavitha. Any other questions? We got a very quiet bunch. Either everybody's really hating us right now, or
Oh, they're like, okay, this sounds good.
all right.
Governor
So can we? Yeah, go ahead, Robert.
Governor Ducey also introduced some plan to help. So that will be on top of the PPP and the IDO, right? And I think it was. I think right now, if any of our tenants will go on the unemployment, well, that's what I've been hearing from, especially like from my wife. My wife company is about 700 employees right now. So it's interesting what was happening, that on top of any unemployment benefits that is available to the public, right now you can also add to, I don't know about the different states, but for in Arizona, anywhere from $650 to $800 a week. In addition to the unemployment benefits that anybody receives. So that will put a lot of tenants in a very good position, actually. I know Governor Ducey had some plans for that money too. If there is any, if any of the tenants have any problems with the rent payments, that money would go to the landlords. I don't know how this is going to work out, but interestingly enough, I just had a discussion with my wife about that, and she said we actually have some employees coming to us and asking us to put them on unemployment, which is blowing my mind. But there's just so much money. If somebody collects $800 a week, that's a lot of money. That's on top of unemployment.
Yeah,
so,
I think
so if
Robert, that
together, it may or may not benefit us as the landlords, but I guess we'll see.
Yeah, and we have been kind of pumping this information to our tenant, and that's kind of what Julie and Maria has been kind of working with our tenant on, which is educating them, like, hey, you maybe want to apply for this. So that's why, like in April, I think we're okay, and hopefully continue. I do have a question from Therese over here that, thank you, Therese, for saying that this is an excellent presentation. I do want to repeat, basically, the updates are sent out monthly. So if you're not receiving updates on monthly basis, like email me or check your junk box. Sometimes they may went there. So we send out the monthly updates. And on a quarterly basis when we do distribution, that's kind of where the schedule goes. What we've been kind of talking about in the beginning of the presentation is sending out even one additional paragraph every 2 weeks, just to let you know how our collections are doing, so that you kind of have a pause on where we at. But the regular email like this will be expected to send out like by 20th every month. We've been kind of sending them out a little earlier, knowing the urgency people wants to know about COVID-19.
Yeah, I'm surprised, Therese. Your question indicates that you have not been receiving any updates from us on a monthly basis. Is that true? Like, if that is true, then just so you know, we've been sending them out every month. You should be having quite a few of them right now.
Yeah. So reach out to us. We'll send you, resend you whatever we have over there, whatever you're missing. Yeah.
So another thing I want to add to Robert's update is, Robert, we are seeing similar cases here where unemployment is bumped up. In addition to the unemployment that people got, let's say they were laid off their jobs or furloughed, they're also paying $600 a week in Texas, and I'm sure that's different in Arizona, it's state to state. For self-employed and independent contractors. So considering our tenant base, that might be a very good option for them, because I don't know when they started there. In Texas, they've already started the payouts. So that will be a great option for considering our tenant base and the demographic. That'll be a great option for them to collect like
Mm.
2,400 a month, which probably in a lot of cases might be more than what they might be making otherwise.
Gotcha. Yeah, I think we also took some advantage of that too, right, Julie?
We have at one of the other sites, we have two residents who are Uber and high-end version drivers. And the state of Arizona actually made full unemployment with all the federal benefits available to them.
Perfect.
So they're actually the ones that are really pursuing the unemployment and keeping me updated with how clogged the system is. So that's one of the nice things is they're getting their money. They're just going to be late.
Yeah.
Right.
Yeah, all of those programs are really important right now, and I'm sure there's a lot of families who suffer. You know, but it does create less incentive to work for people, unfortunately, and that's. I would rather have people receive the money and hopefully have a faith in them that actually will continue to go to work and pay their obligation to be a responsible citizen. But like I said, even from my wife, we do notice that some people just simply want to go on unemployment, and we say, and her company says, well, you don't have to. We have work for you. You can come and work like nothing happened, and
Yeah.
they opt out and they go on unemployment. So, but that's a different topic for another webinar that's not related to this.
Yeah, and Tushar made a comment here that the federal government basically had a new policy that allows more workers to qualify for the unemployment, and then also increased the monthly unemployment. And just so everybody knows, I mean, yeah, we've had conversations that it's concerning because where's the incentive for people to work? Well, just so people know, that policy is set to expire July 31st. Okay, so that's only a temporary policy. So hopefully things settle down with COVID-19, economy opens up, and then that expires, and people will be more incentivized to get back to work at that point. So we'll see how that kind of goes. But just so people know, that's a temporary fix at the federal level.
Gotcha. Okay, looks like Teresa was actually asking about the presentation. Could we do this more often? So I think we could consider like doing quarterly. Again, we want to do some more frequent updates in terms of collection in the next couple months. Yeah, this is maybe something that we can kind of consider and get back to everyone on that. Yeah. Cool.
Perfect. Yeah, I think like you said, Elisa, we're going to plan to do, I mean, typically you should be getting the investor updates, which are the end of the month. So for example, between the 25th and the 30th of April, you will get the March investor update. And that's how we've been doing it. Going forward, we're going to send a collections update, which will be around the middle of the month for that current month. So in May, you would get a collections update for May. And at the end of May, you would get the full report with the expenses and everything included for April. Okay, so you should be getting 2 a month, and the first one will be COVID-19 collections. The second one will be the previous month's full report.
Yeah, I think what Teresa means that she's actually getting out the monthly update email. I think she was requesting a monthly presentation. So I can't fully commit to that right now. We'll have to kind of discuss internally the frequency of us be able to kind of get on the call over here and kind of taking Julie off some of the valuable work that she's doing over there. So we'll figure out something, but maybe quarterly is something that we could do. Yeah. Okay.
Perfect.
Great. Well, awesome. Looks like that's all the Q&A that happened over here. And we'll record this and send out this email today, maybe tomorrow once the video is done making itself. Hopefully to chat with you guys soon. Anytime, please reach out to any of our sponsors over here for any questions that you want to direct at us. We're open doors. Yeah. Thank you.
Everybody, have a good day.
Thank you all.
Thank you.
Bye, guys.
พูดเลยหน้าตายิ้มอย่างเดียว
ทุกคนหน้าตาดี